How do you measure the health of your business? Unfortunately, business doctors aren't a thing. And if your business seems a little under the weather, how do you know what to do about it? Today, we're going to talk about financial reporting and how you can use it to give your business a little checkup. No medical license required. If you're more of a reader, check out the article below. And don't forget to hit like and subscribe for the rest of our series, Ready, Set, Goals. Whether you're franchising a restaurant or you just opened the world's teeniest online knitting store, everyone can benefit from financial reporting. When you make a financial report, you're using income statements, balance sheets, and cash flow statements to give you and your stakeholders, if you have them, a heads up on whether your business is getting all its fruits and vegetables. Use your financial report to get insight into those important food groups. Your break-even point, which is the level of sales you need to break even for the month. Breaking even is when your total cost and total revenue are equal. Your cash collections, which can tell you if your business is collecting enough cash to operate the business. Debt financing is if your business is making enough money to repay debts on time. Combined, this information gives you everything you need to pay your taxes properly, attract investors, make big decisions, and catch mistakes. You know, the healthy functions of a business. But what types of financial reports should you be running? There are three main ones. Number one, you've got your classic balance sheet. A balance sheet shows the company's assets, liabilities, and equity as of a specific date. You can figure out your balance with this simple equation. Assets minus liabilities equals equity. Number two is going to be your income statement. This shows the company's revenues and expenses for an accounting period. You can determine your income by calculating revenue minus expenses equals net income. And finally, you've got your cash flow statement. Naturally, this shows the company's cash inflows and outflows for a period of time. Calculate this by adding your beginning balance in cash plus net changes in operating, investing, and financing activities, and you'll get your ending cash balance. Oh, don't worry, we're not done yet. Now that you know how to handle calculations for a financial report, we'll show you an objective way to measure the health of your company. They're called Key Performance Indicators, or KPIs. And they're an important part of any business checkup. Your first KPI is going to be your gross profit margin. This shows you how much of your revenue is profit after you factor in expenses. To get your gross profit margin, just do revenue minus cost of goods sold, and then take that number and divide it by revenue. Boom! The second KPI is one that's near and dear to my heart: net profit. Net profit is how much money you have after you've paid all of your bills and expenses. In other words, just do total revenue minus expenses to get your net profit. Finally, there's current ratio. That's how you determine if you have enough money to fund a large purchase. To find your current ratio, divide your current assets by your current liabilities. Take note, if your current ratio is less than 100%, you may not have enough cash coming in to keep on top of your bills. So it's good to check this one often. All right, I promise I am done showing you equations. Now, let's put it all together and generate a comprehensive financial analysis that shows your potential investors just how healthy your business is. First, start with your company overview so investors can understand who you are and what your company does. Second, dive into your investment thesis, including positives and negatives of your company. Third, don't forget to cite your sources. Fourth, note any significant financial events that may have impacted your company's finances. Fifth, if you have one, include your company's valuation, which is an independently determined value for your company. 6. List risk factors that could negatively affect your company's valuation. 7th, include detailed results. The financial reports from earlier will help you here. And finally, always, recap. That's it. Don't be afraid to ask for help from a financial analyst, an accountant, or a bookkeeper. Have you heard about QuickBooks Live? Much like a great doctor, they can help you monitor the health of your business.